How you guys doing? Welcome back to today's lesson 39. The sectors that I use, we're going to discuss all 11 sectors, what I see in them, how I chart them, why I like them, and why I watch them. This is basically really tied to the indexes that I use, but they're more micro level, but they're so useful in giving us great information. Today we're going to cover all 11 of them, what they do, what's a part of them, how big they are, how small they are, how they move, overall performance over the year, because these are not created equally, but the opportunity in them can be equal with proper technical, fundamental, and mental analysis, as we've discussed with the macro indexes. Secondly, we're going to talk about RRG graphs and how to scan with those and how you can really put yourself in a good position with RRG graphs and just technical analysis in the first place. RRG graphs I get from stockcharts.com. It's $30 a month. I only charge my patrons $25 and they get them every single day. So you can use those for free with me, or go pay $30 for them off StockCharts. There's another free website, is great. We'll discuss RRG graphs though today. Next, we'll discuss the fundamental side of this and the cycles that we go through with the business cycle and how each sector under different circumstances of GDP, inflation, time of the year, have stronger and weaker times. And what that means is that if we have high inflation, maybe the better choice is defensive over cyclical. Maybe if we have low inflation or high GDP, do you focus tech or financials? Where do you go? And with these great fundamental tips, it'll really help you zero in on good opportunities and where to put your money, with opportunity cost dictating the best place, maybe utilities instead of tech, or maybe discretionary instead of, energy, whatever it may be. Then we're going to chart them as a whole group. Maybe we'll do that first. We're going to chart these and show you how TA does work. Supports, resistances, trend lines, patterns do work on Thinkorswim with these, and go through them and show you how you can do it yourself. Of course, when you watch this video, market conditions may change, but again, the technical and fundamental analysis do not change. Your strategy can change. Short them, option puts, calls, whatever it is, but the rules remain the same. Technical analysis and sectors do work, and I'll show you that. And then lastly, sector rotation and then how to trade them. I think it's really important. Probably the easiest money to outperform the S&P 500 is sector trading. With an RRG graph and technical analysis, yeah, you may only make 4% a month trading these slowly, but over 12 months, you can make 30-40% a year fairly easily just playing the sectors and being really good with sector rotation, RRG graphs analysis. So that being said, let's discuss the 11 sectors, how I use them, and how they can be almost your go-to starting point for morning routines and also your ending points when it comes to researching at nighttime. With that being said, lesson 39 sectors, let's get into it. So to begin, there are 11 sectors, the newest one being communication services as of recently. These 11 is what every single stock is put into. Of course, every stock has an industry, a sector, and an index. Now, some may not be on an index, but mostly your bigger caps will be on most indexes, or maybe Russell 2 or 3000, whatever it is. But every single stock does have an industry and a sector. There are 11. Let's look at them real quick together. So this is a great sheet, which will be in the description box down below. First is comm services. These are obviously in alphabetical order, not importance or anything. Comm services, you have advertising, broadcasting, cable and satellite, publishing movies, and entertainment, interactive media and services, as well as other provide telecommunications like fixed line, wireless, cellular, high broadband, fiber optic cables, all those kinds of things. So anything that deals with talking, anything that deals with projecting and media and entertainment goes into communication services, from AMC to Verizon. All that's communication services. If you're communicating through fiber optic wires and wireless, or giving any kind of satellite broadcasting or advertisement, that's going to be comm services. Second is consumer discretionary. Of companies that are most sensitive to economic cycles is automotive, household durable goods, textiles, apparels, leisure equipment, hotels, restaurants, and consumer-related services. These are the companies that most rely on GDP, most rely on world events, and these are ones that will get cut first. Discretionary. Money you can stop spending, or folks spend extra to get fun things. Hotels, cars, whatever these may be, goods, textiles, clothing. You can not buy new clothes all year and be fine. These are the first things that are cut when it comes to the GDP, with inflation rates and everything else dropping. These are the first to usually be cut. Followed up by consumer staples. Obviously, the staples implies they're less sensitive to economic cycles, such as manufacturers, distributors, food and beverage, tobacco, producers of non-durable household goods and personal products. So when times get rough, staples usually stay the same. They're not really going to be that affected by the macro level stuff. Of course, they can be in some respect, like if tobacco has new laws against it, or food or beverage has new FDA approvals, or whatever it may be. sure, that may have a different issue on it. It may have a different impact on it. But usually consumer staples, very steady, not affected by the macro level stuff like GDP, business cycles, and inflation. Next is energy. So far, the last few years, the only one to be negative more often than not. Interesting. Energy. These are the businesses that deal with rigs, oil, drilling, energy-related services, engaging in exploration, production, refining of transportation of oil and gas production, coal, and consumer fuels. That's imperative with the terms fuel being the main crux of it, and oil mainly because of, you have your solar power, you have electronic vehicles, you have green energy. This one is probably the most likely to have different inclusions, such as they may include solar, may bring on electric vehicles and EVs and stuff. Hydro possibly, but as of now, oil and drilling not doing too hot over the last few years, and it has the most boom or bust cycles in my opinion. It's a great one to play, but it is very volatile given it's very dependent on GDP, price of oil, all those kinds of things. Next is financial, super stable usually, banking, mortgage finance, consumer finance, specialized finance, investment banking, brokerages, yada yada yada. You know what financials are. Big banks, they deal with corporate lending. They're going to deal with institutions of financial reinvestments, those kinds of things. Huge blue chips usually. These things are very steady. They're easy to play. Next is healthcare. Companies and manufacture healthcare equipment, supplies, and provide healthcare related services. Companies provide research, development, production, marketing, pharmaceuticals, and biotechnology products. Very volatile at the end there, very non-volatile towards the front. A lot of bigger hospitals and XLV stocks are pretty steady, but your biopharmaceuticals and your biotechnologies with FDA approvals can get absolutely insane, going up and down 100, 200% fairly quickly, or doing absolutely nothing and going bankrupt. XLV is a mixed bag, huge market cap, they're fantastic stocks to play. Next is industrials. Obviously with aerospace and defense, construction, engineering, building products, electrical equipment, and industrial machinery. These are all things that deal with printing, employment, office services, environmental services, transportation services like airlines, carriers. We have our marine roads and railroads. All those are included in industrials. You can think about the Industrial Revolution. If that affected it, it's most likely going to be in industrials. Next is information technology, aka tech, XLK. You have application systems, database management, internet, technology, consulting and services, home entertainment, everything that deals with semiconductors, anything that deals with technology of applications and websites and web cores and those kinds of things. Web core is not a word, it's okay though. But all those kinds of big tech like Microsoft, Apple, all those types of things are read at XLK. Usually the highest growing, the most volatile. This one's had the most traction over the most years usually. This is a great one to start off with. Usually fairly safe. Great plays are in XLK. Next is materials, XLB. We have our basic materials. This is going to be chemicals, materials, glass, paper, forest products, packaging, metals, materials, and mining companies, including steel. Steel is great. Axe and CLF are fantastic. You have great mining stocks with you have CRK and these kinds of stocks that deal with getting materials and minerals. If gold is soaring, if silver is soaring, the first place to look is always XLB. Usually a pretty calm sector, but again, some really good plays are in there. Next is real estate. We have obviously going to have real estate management and development services and trusts called REITs, and then of course your exception of mortgage REITs. So you have companies that deal with buying up property and then giving you a return based on the income they get from renting or leasing, whatever it may be. You also have your companies of like BlackRock or whatever it may be that you invest in the company that then buys those other properties. So XLRE, anything that deals with real estate will probably be in there. REITs are great, but they can be kind of risky sometimes, but you want good dividend income. REITs, a good place to check, for sure. And lastly is utilities. Of course, we're going to have consider electrical, gas, or water utilities, and that you have at your home that's produced and distributed based off power. So all the places you pay for power bills, anywhere for water bills, anywhere for those kinds of things, water, gas, natural gas, all go into XLU, and those are 250 stocks at most, but again, very steady, don't have the most steam up or down, but very consistent, easy to play. What's important to realize is this, and I'm going to show you this chart real quick, is that these are not produced equally. We can see with different colors, the different sector they are from the last decade and how well they're doing. A great example is this. XLU in 2011 was 19%. The next year, it was only 1.29. It's going to change every single year. Some are boom, some are bust. Others produce better than others. XLU, again, can go up really high or go down really low, just like everything else. We can see something like XLK not doing the greatest, but then pretty consistent,